Finance is one of those industries that many people find it hard to trust, and honestly, it's not difficult to see why. From economic downturns created by financial crises to people losing their entire savings, finance has earned a reputation that's hard to shake. We've seen essential goods turned into speculative assets, manipulated for profit, and in the process, finance companies have made billions of dollars. Yet, they rarely show us the value they contribute to society as a whole. However, despite all of this, finance can be a vital tool within any economic system. When used properly, it has the potential to do an immense amount of good. In any economic system, finance plays a crucial role in effectively allocating resources, facilitating trade, and enabling people to convert future value into something that meets their immediate needs. But it's not exclusive to capitalism. A strong financial system is critical in virtually every economic structure, and bad financial systems have been the downfall of many alternatives. Finance is a tool that can either help or harm, depending on how it's wielded. In today's world, the finance industry has ballooned into one of the largest and most influential systems on the planet. We've seen the rise of megabanks, hedge funds, private equity firms, sovereign wealth funds, and countless individuals investing their money. It's easy to wonder if we've lost track of what this seemingly simple industry was meant to do. But in reality, the financial system is far simpler than most of us realize. Yet, the complexity added on top of this system has become a major part of the issue. To truly understand how the finance industry is supposed to function, we need to zoom out. What is finance meant to do for an economy, and has it kept up with that original mission? If not, what are the consequences of a system that has grown too large? These are important questions, and they're becoming more urgent as we watch the growing role that finance plays in our global economy. To answer these questions, let's first break down what finance is meant to do. In the most basic sense, the financial industry has always served as the intermediary between capital and the other factors of production: land, labor, and entrepreneurship. At its core, finance takes money that's not being used and directs it to productive economic activities that will generate a return on investment. When it comes to land, finance should allocate capital to property development, directing investments toward ventures that will add value. For labor, the financial industry provides capital that helps workers own assets through mortgages or access credit to purchase what they need right now. Here, finance is trading present capital for a share of the future value of that worker's labor. Then there's entrepreneurship. Finance is supposed to allocate capital to ideas and businesses with the potential to add value to limited resources. This could mean funding a business idea, like a new technology, or helping a company bring a product to market. In a perfect world, the finance industry helps allocate the capital needed for the most promising ventures, ensuring that only the best ideas receive the funding they deserve. Throughout history, this role of finance has been evident. A perfect example can be seen in the Industrial Revolution in Britain. This was an era of massive technological innovation and an increase in production efficiency, which led to economic growth. Large-scale enterprises required significant capital investments to fund the construction of factories, textile mills, and mechanized equipment. It was finance that enabled this growth, and the financial capital invested in these projects played a huge role in the success of the revolution. As time passed and financial institutions grew, new markets emerged. By the 20th century, the financial industry had expanded from investment in production to investment in consumption. The rise of consumer credit was a logical next step. For the first time, the finance industry allowed people to live beyond their immediate income, enabling them to buy goods like cars, furniture, and appliances, things they wouldn't be able to afford without credit. Over the decades, the finance industry continued to grow, offering more ways to borrow, invest, and spend. But with growth comes complexity, and as the financial industry evolved, its impact on the broader economy became harder to gauge. Today, the finance industry is massive, Some of the largest financial institutions generate revenue that rivals the GDP of entire nations. While the size alone may not be the issue, there's a deeper problem. As finance has grown, much of its power has shifted away from long-term productive investments and towards short-term speculative activities. In other words, much of the capital is no longer going into businesses or industries that create real value, but rather into speculative trades that are driven by the need for quick returns. As an example, consider the world of high-frequency trading. Algorithms and machines are making split-second decisions, capitalizing on market movements before the average investor even has time to blink. In this game, those who have access to better technology and insider information have the advantage. This creates a situation where, instead of creating tangible value, the industry simply redistributes wealth. And this doesn't just happen in the stock market. Similar practices are seen in commodities markets, real estate, and even cryptocurrency. But while short-term speculative trading is a part of the finance industry, it's not the entire picture. There's also the issue of information asymmetry. This is where one party in a transaction has more information than the other, giving them an unfair advantage. This happens frequently in financial markets. For example, a corporate executive might know about an upcoming deal that will increase their company's stock price, and so they buy stock ahead of time, making a profit once the news becomes public. While this is an illegal act known as insider trading, other forms of information asymmetry are completely legal. This creates an environment where, instead of contributing value to the economy, many financial actors are simply extracting value from others. The increasing size and complexity of the finance industry aren't just about the shift towards speculative activities, they also come with wider societal consequences. As more resources flow into the financial sector, less talent is being directed toward industries that create tangible goods and services. Professions like teaching, construction, healthcare, and scientific research are all in need of skilled workers. But as finance continues to attract the brightest minds, these sectors suffer from talent shortages, creating long-term inefficiencies in the broader economy. Moreover, the financial industry benefits the wealthy far more than it does the average person. The richest 1% own a disproportionate share of financial assets like stocks, bonds, and real estate. This wealth disparity has grown significantly over the last few decades. A McKinsey & Company report found that asset price inflation has created $160 trillion in wealth globally, but most of that wealth is concentrated in the hands of the wealthy few. The rest of society has seen little benefit from this growth, as wages have stagnated while asset prices continue to climb. This is where the critique of finance comes in. It's no longer serving its original purpose. Instead of being a tool that helps individuals and businesses grow, finance has become a game for the wealthy few. The speculative activities that drive the markets are largely disconnected from the real economy, contributing little to the production of goods and services that people rely on every day. Despite all of this, finance still has a role to play. It's a necessary part of any economic system, but it's clear that something has gone wrong. As the finance industry has grown, it has lost sight of its core function to allocate resources in a way that drives productive growth and adds value to society. Instead, it has become a system where wealth is extracted rather than created. As Rana Faruha, a business columnist for the Financial Times, puts it, finance is supposed to act as a bridge, connecting savers with borrowers. But today, only a small fraction of the capital flowing through the financial system is being used for productive investments. The rest is tied up in short-term trading, speculative activities, and asset price inflation. In a world where finance has become so disconnected from real value, it's no wonder that so many people are skeptical of the industry. Ultimately, the future of finance needs to be reimagined. If it continues to grow unchecked, with too much focus on short-term speculation and wealth extraction, it will continue to widen the gap between the rich and the rest of society. But if we can return to a system that prioritizes long-term investments in real economic growth, finance can still fulfill its original purpose to help people, businesses, and economies grow. The question is, will we be able to recognize the flaws in the current system before it's too late?